Hello, everybody. Kirk Spano, and I am meeting today with Chris DeMuth from Sifting the World over at Seeking Alpha. And I just wanted to bring him to you, as most of my readers know, and people who watch my podcasts. I work primarily with accredited investors at the investment firm level, but I publish investment letters that I think are generally well rounded. But there are certain things that I think require an expert, require a different way of thinking, a way of getting an edge in the market. So I look for people who I think can help me be a better investor. And Chris is one of those guys. I've been reading his work on Seeking Alpha, man, 7, 8, 9 years, I think. And I have found it to be a brain exercise in really just becoming a better investor. So, Chris, welcome. Thank you for meeting with me. And can you just tell folks who you are as an investor?
Kirk, thank you for having me on. I would say I am certainly a value investor. I am a counter, not a soothsayer. And within the firmament of value investing, I'm interested in kind of off the run, kind of one-off situations that have kind of some kind of event-driven aspect to them. My background and interest was originally in public policy. I did kind of government risk analysis for corporations, largely insurance companies, petrochemical companies, and then also hedge funds. I did work in DC for merger arb shops that wanted to understand regulatory issues around deals, legislation, litigation, other things that had a lot of policy sensitivity to them. So asbestos, tobacco industries where government intervention is a big part of it. If the market's somewhat efficient and the price system works really well, I spend all of my time thinking about the exceptions. And if you want an exception to efficiency, the government's a good place to start.
Right.
It can be arbitrary. It's very porous in terms of information. So if you spend enough time trying to understand really good information sources, there's a lot that you can get in DC. So I did that for a number of years, left to work for a client, left that to start my own fund, and then have been at Rangeley Capital ever since. And so we look for mispriced securities. We look for opportunities where we can kind of survive downsides and prosper from upsides on event-driven investments. What category those are in, I answer kind of reactively. I don't wake up in the morning knowing ahead of time where the opportunities are. The opportunities are wherever they are, and they tend to cluster so that you'll have some years where there's a category where essentially all of them look attractive to me, and other years where none of them look attractive. Despite the fact that I've done a lot historically in M&A, I had concerns about deal financing, and I had concerns more recently about kind of things specific to this administration's FTC and DOJ that kept me out of wanting to do much of any M&A or doing M&A arbitrage after suits were filed. But I kind of wanted to see the lawsuits first. Some have been lost, some have been won, some have been settled. The FTC in particular has sure been losing a lot and bringing some preposterous cases. So that leaves good opportunities for us there. But we kind of really wait and want extremely wide spreads. Price on merger arb spreads have a tendency to attract very different type of investors. So kind of a traditional merger arb shop that focuses on that might want very high probability deals. I tend to be much less interested in those. I tend to kind of wait until there's been some disaster before getting really interested. Super wide spreads leave you opportunities to kind of do okay or do well if there's a settlement, do okay sometimes even if there's a break. But that's something we've done historically. I think we've done a lot recently of litigation situations as well, both in some cases litigation financing as well as equities. Actually, lots of different parts of the capital structure, notes and warrants. But we're any geography, we're any part of the cap structure, we're any market cap. I really like things that are on the very periphery of the public market. So I'm very interested in demutualizations, things that are kind of coming and going, but barely in the public market. And that's what we do. We're very heavy on research. I'm somewhat light on trading, keep a somewhat concentrated book, and just like trying to exploit imperfections in the price system.
Okay. A lot of the thing, there's a lot to unpack there, but I've been reading your site now for a few months. I disappeared for the World Series of Poker, and I've been back to working again. First losing
how did you do in the World Series of Poker?
First losing trip since 2017. I cashed the first two little events I did to warm up, and then I got sick. I don't know what I got. It wasn't COVID. I tested, so the thought is it was RSV or just bronchitis or something, but I was so sick for the last 12 days of my trip that I basically missed cashing 3 giant tournaments by 50 or 100 people, and there's 4, 5, 6, 7,000 people in these tournaments. So three close but no cigars. If any one of them had cashed, I'd have broken even. If 2 of them had cashed, I would have been able to pay for another car, but such is life.
Do you listen to Nate Silver and Maria Konikova's podcast, Risky Business? They have a good one. They kind of go back and forth between a little bit of politics, a little bit of poker, but it's a good conversation to listen to. Isn't it?
Oh, I'll have to check them out. I'm reading a book from Annie Duke right now, Thinking in Bets.
Oh, it's great.
And I read it. Yeah, I read it like 5 years ago, so I'm going to read it again and do a little review. And I'm hoping she'll do an interview with me, to be honest with you. I'm
a big fan of hers.
Yeah. She's I don't think people understand why poker is so relevant to investing. Mm-hmm. And it is. And I wrote a little article, Investing Lessons from the World Series of Poker, that's up on Seeking Alpha, that I thought hit on 3 good points, but I think there's a lot more. And it revolves around, and this is something that you're working with, is making decisions with incomplete information and trying to interpolate, okay, this is where my risk is and this is where my upside is. So if I can virtually eliminate risk, then I can do okay because enough of them will make money. And I don't think a lot of investors properly categorize risk in their portfolio. I think that a lot of folks, they hear of something and they read a couple articles and maybe they glance at the company presentation and then they invest. And this is money that they sweat for. And I don't think that they understand how much risk they're taking. In fact, I think a lot of people who are married to S&P 500 stocks right now, if they really understood where some of the valuations stood, unless we get a productivity miracle, which AI might bring, I don't know. But, there's, to me, 200 or 300 stocks on the S&P 500 that I wouldn't touch with your wallet. So, I really enjoy reading your work when I can take a look at how you break something down or you point at something and say, this is something to work through. So I often think about risk that can hurt me. And I try to build in the Seth Klarman margin of safety thing because I really just don't want to not understand the risk that I'm taking. That's something that your service really, even if people only subscribe for a year, just to go through a year-long kind of thought process and training of your brain for investing, I think would probably be helpful for them. I heard you mention demutualizations. I've been involved with banks that demutualized and went public. I've taken a look at a lot of the oil and gas. That's where I made most of my money early on. That's how I got found by MarketWatch. And Lena Khan right now on some of those energy deals is being pretty aggressive. So I was just at the Hard Energy oil and gas conference in Fort Worth in May, and there were not a lot of complimentary things said about her. And I'm really wondering what the goals are behind some of the lawsuits and challenges, because they haven't broken any of the deals. Really all they've done is extract a little bit of concessions from the oil and gas companies, and maybe that's the goal and maybe that's fine. But as an investor, what I have found is that there was some M&A, there was some arbitrage in there, because people weren't sure that the deals would go through, and it was money just sitting on the table to be picked up if you thought that the deal would go through. And ultimately, I haven't seen one that actually got busted. So I think they all did go through. I've made money on like 3 or 4 of them, the Pioneer and Exxon, and things like that. And I was lucky that I've been in Pioneer a long time. So I don't know. What are you seeing with M&A that's out there right now? I don't know if you're familiar with U.S. Steel. If you have a thought on that, I think that that's an interesting one. What are you seeing out there that's making you going,
Yeah, hyper aggressive FTC and DOJ. The FTC in particular has had an abysmal record of winning cases, but I think to Lena Khan and her ilk, the process is the punishment. She can slow deals down. She can also extract qualitative concessions, even down to things that are completely outside of her statutory remit. So she'd say, look, we're nice company you got there, nice deal you got there. It'd be a shame if something happened to it. Here's what we want in return. So very aggressive. And sort of enumerate when it comes to the actual economic issues around oil and gas in particular. A lot of these are worldwide markets. And so it's not antitrust. It's just a government that has things that they want, and they'll hurt you until they get it. But we've been very wary about getting involved in a lot of deals while they're in office. We could have a different administration, and we could have we'll certainly have a different administration. We could have a different set of regulators. If the Democrats win, it could be similar. But if the Republicans win, it might not be that different. The Republican vice presidential nominee has spoken very favorably of Lena Khan, and in this kind of populist era, companies and deals are kind of caught in the middle between right-wing and left-wing populists that are often very open to not only aggressive antitrust, but using the antitrust agency for other purposes. So that has kept me following, but small or out of a lot of deals that we would otherwise be in. There are some exceptions. There's some things that I've owned and own and have written about recently. Target Hospitality, ticker TH, is one example of kind of an interesting one right now, because I think that one has quite a bit of election sensitivity to it. I think that would likely be benefited if the Republicans won. It has facilities for housing migrants. Biden recently cut off funding to their largest facility while they were the subject of a takeover offer that called that offer far more into question. But I think a new administration, a Republican administration, would likely be more open to renewing that facility in particular or dealing with them generally. So I think that in terms of opportunities for this election, I've kind of written about a number recently, and that's one that I really like, but they're few and far between. I think merger arb generally would do very well if Trump won, with the thought that there would be a more lenient FTC and DOJ. But meanwhile, I'm studying a lot of these, but out of most of them.
Okay. So where are you turning your capital to then?
Well, TH is one example. I would say that we have a couple things that are specifically policy sensitive that we wrote about. Freddie and Fannie prefs are another. And then we have been involved in a number of litigation situations that have been interesting to us, that we thought were and think are promising. Another one that we're following pretty carefully and involved in is the ESIP banks, the banks that were given kind of very favorable government financing, and think that they would be valuable as they are, but also very attractive takeover candidates. So Ponce, ticker PDLB, is one that I think is kind of undervalued, misunderstood by the market. and a likely takeover candidate that would allow the buyer to kind of get at this super attractive, interesting government financing through this ESIP program. So that's been a big focus of mine. And then here and there, activism. I don't love the distinction. If you own something, I think kind of the natural status should be that you have a say in how it's managed. If the people who are paid to manage it well are doing a good job, that's fine. But when there's a stumble, I think it should be kind of the normal order of things that shareholders get involved. So there's a number of situations where I think there's value to extract, but it will require a bit of work from owners. So been involved in some activism as well.
Okay, super interesting. I watch a company here in Milwaukee called Kohl's. So the Kohl's department stores, and I understand the asset value underneath that company. And so you've seen activists and private equity try to get a hold of Kohl's. And I think that they want to do to it what, Lambert did with Sears and with Kmart, and just part it off and let it wind down. And the management here and the shareholders don't want to see that, but they would sure like to see that stock price get back to where it was, which would be about a triple. And so, there's a company that I think, I don't know if there's such a thing as a benevolent activist investor, from the standpoint of they're just going to play nice with the management, right? I mean, they're always going to push on management because that's why they're an activist. But I see companies out there where I take a look at underlying real estate value in particular, or just something that's broken with the business that they should jettison. And I wonder why shareholders are so reluctant to break with management sometimes, or to at least just push them a little bit. Because to me, and this is a subject that I cover over and over and over again, I think there's a lot of bad executive management, in some of the companies, that they extract value for themselves. They kill shareholder value along the way. And, I look at the S&P 500 and I could rattle off 100 companies, I think, that I'm like, why is management managing the company the way they manage it? I don't know that means there's an opportunity, but
and there's a certain meritocracy when I look at a lot of small cap companies, and something looks kind of the twofer of, I'm looking at a company with a very small market cap, and I'm looking at a company that appears to be undervalued relative to its fundamentals. One of the things that I frequently discover is, oh, that's the reason why your company is very small and the market doesn't want anything to do with you, because a lot of the people are either flat out literally crooked, or they're just terrible. And even though I sadly find myself far less frequently an investor in these, when you look at mega cap companies from time to time, you listen to a CEO and think, it really checks out that you're the CEO of Amazon or Google or some of these other companies that are famously huge and successful. And the difference between people who manage $1 trillion companies and $100 million companies is stark. And also the kind of perversity of their incentive structure and the entrenchment related to smallness has a couple problems. One is frequently, even a fairly modest income is material to them relative to their equity ownership. And secondly, the smallness is its own corporate defense, because my lawyers and proxy solicitors and so forth, their bills don't really scale down. And I think there was a model who said she didn't like to get out of bed for less than $10,000, and I think she was berated for it being snobbery, but it's actually just using money as a tool to prioritize. My lawyers don't like getting out of bed for less than $1 million, and so you kind of have to back into how much money I'm going to make to be able to pay the people involved in a process. And it makes it really hard when you're talking about a tiny company for shareholders. You'd think in some respects it should be easier, buy a few $1 million of stock and have some say, but it doesn't really work like that, because the boards are frequently golfing buddies of some local CEO, and they're kind of the members of the Rotary Club or something. They all know each other. They're completely impervious to shareholder thoughts on what maximizes shareholder value, and whatever they get for being on the board, they really like. So that can be a problem. But yeah, no, we have a number of activist situations where there's something that I think shareholders could do to unlock a lot of value. The one from this coming week, Inhabit, ticker EHAB, is one that I own that I like. I think it's enormously undervalued. It was a spinoff. It's kind of the one kind of remaining standalone hospice care company, undermanaged, done very, very poorly compared to, even though they're not, for the most part, not standalone public comps. You can kind of see the competitive businesses within larger companies have done very well. They kind of botched a sales process that I think shareholders, if they take over next week, could just rerun and sell for a substantial premium to what it costs. It still costs, just the rough math, you can buy shares for under $10 a share. I think management under shareholder control, it's worth at least $12 as a standalone company. It's worth probably 17 in a deal. And I think that there are absolutely both private equity firms that would be interested, and strategic companies that could acquire it for kind of something in the high teens. That actually is another one that probably could benefit from a change in administration. A little more leniency on the antitrust review would be a help. And so that could come early next year as well. But, I think it's kind of a cinch under 10 as long as shareholders can take over at least a substantial part of the board next week.
All right. So, I talked a little bit about the large caps, and I take a look at the management of the really big successful companies, and I don't worry too much about them. It's really those 30, 40 billion dollar companies that used to be 100 billion that I'm like, what's going on? Mm-hmm. Where do you see the sweet spot then? Do you see it kind of like around the threshold of Russell 2000, those $200 million companies, or even smaller?
Yeah, no, I think that's probably right. And historically, I've looked at actually the reconstitution as an opportunity from time to time. It's hard for us to get a substantial position for something that's much smaller than that. So, yeah, that's, I would say I look at all market caps, but that's where I often end up.
Okay, so in the hundreds of millions.
Yeah.
Okay. Yeah, that's a space that I play in. From both angles. One, from the value angle. Sometimes you just find something that the market doesn't value because it's a small cap or almost a micro cap. And then sometimes there's growth there that is just nobody loves right now. And one of the things that I've learned, and I've studied this extensively the last 3 or 4 years, is, you have trading rooms and you have traders and you have kind of this loose affiliation of hedge funds and trading rooms, and then all the little traders, and they gang up on some of these small companies and really can do some damage to their capital structure. I think there was a paper, I don't know if it was through the Federal Reserve out in San Francisco. Somebody wrote a paper about how you can gang up on a small company, and even if it's a pretty good company, you can mess up their capital structure, which will end up messing up the company if you can, short it into oblivion. And I'm not against shorting. I think a lot of companies should be shorted. But I think every now and then you find an opportunity in those heavily shorted stocks where good management could really blow that up and take the share prices higher. And then the other thing that I have seen on the M&A side was, I'm in an industrial area, and some of there's small companies here, small listings, usually in the tens of millions. And the private equity firms come in there and just take them private. But they, the share price all of a sudden is like, nobody wants it. It jumps up, right? It gets that L shape and it's gone. And so I found some of those out there. Are you finding any particular industry to be more susceptible to, really just getting bought out at a premium and disappearing quick? I'm trying to find those opportunities, and they're hard because the amount of reading you have to do is just off the charts and getting familiar with these companies.
If you look at banks and thrifts, I mean, there are thousands and thousands and thousands of small banks in the US.
Okay.
The vast majority of them have no business being separate standalone public companies. And so you just look at the kind of regulatory compliance issues, the just public filings, and I think that the small banks and thrifts is a interesting area. I think that demutualization is generally a big interest of mine. So, I have my mailbox every day can almost never fit in the mailbox. I have a separate like US Postal Service bin because I get so much junk mail from all of the banks that I have accounts in from all over the US. But I think that if you look at the institutions that kind of made it halfway across, that there are mutual holding companies that are kind of orphaned, that don't really have growth prospects, that have not done that well in the public markets, and are likely to be remutualized. So that credit unions, you look at the mutuals, they tend to be cash rich, incredibly price insensitive buyers if they want to buy something. And if you look at incentives, always a good topic to look at, and you look at the decision makers, they frequently can prosper with scale and don't really care at all what they buy for. So you get just these gaudy premiums spent on mutual holdcos that come to the market and are abandoned and are likely to not do that well publicly, and instead of kind of going through the whole process. And you don't have to pay for that many shares. You have to pay for less than half the shares. So you just can give them monster premiums with credit union wampum. And so I think that those are really good opportunities right now. We've seen huge kind of consistent sales, huge premiums. And then the demutualized institution, there's a period before which they can't sell. You can't sell for the first 3 years, but then in the fourth and fifth year, 75% of them sell. So that's a kind of a consistent area to look at. Rhinebeck, ticker RBKB, trades for just over $8 a share. It's worth that as a standalone, and it's worth a huge premium to that to a buyer. So I think that that's one that I've been looking at that I think is a really interesting takeover candidate. But there are hundreds that probably will sell, thousands that probably should.
Yeah. I actually found 2 in Wisconsin. They're in my backyard, so I've been keeping a track of the banks around here since I've been in business, 25 years now plus. And I first stumbled into that realm accidentally. A client of mine owned a mutual, or had an account at a mutual bank, and apparently when they went public, and everybody who had money there, and I don't know if it's proportional. Is it proportional to what you have in the bank, and are you allowed to buy more, or how do the mechanics of that work? Because I saw them make a bunch of money.
Sure.
It became TCF after a while.
Yeah. So I've done many of these for decades. And so a typical structure is, you have something like $500 accounts, areas that have a lot of professional depositors. So kind of New York, New Jersey, Florida. Sometimes you max out, put as much as you can put in under the federal insurance, put a couple $100,000 in an account, but typically 500 is fine, especially in rural areas where you don't have a lot of pros. And then, so like Eastern Bancorp, that's one. You get a small account. When they went public, it was a low price. It was a good geography. And they actually had a pretty good kind of credit standard at their institution. So I really liked Eastern, and it was, you could buy 200,000 shares for $10 each. Sent them a check for $2 million. It doubled in pretty short order. We got our shares called away. I wrote calls at 20 and then kind of lost track of it. I've kind of been picking away at paying a little bit more of attention since then, because they came, I believe, almost round trip. I lost track. But that's a pretty typical one. I think the worst we ever did was up kind of 10% the first day. The best we ever did was up 50% the first day. Smallest tends to be a few $100,000. Biggest was like $9 million. But that's kind of the range. And if you fully max out your size, you can ask to participate, kind of oversubscribe and buy more. It's really hard for regulatory reasons to ever own more than 9.999% of these banks because you need Fed approval, and they're either slow or deny that approval. But you can sometimes get up to just under 10% at super low prices, and then wait for 3 years and then hope that they're one that sells in the fourth and fifth year. So it's a lucrative opportunity. It is a bit of a bother to participate, and you kind of learn tricks along the way on how to qualify and how to exploit it profitably.
Okay. Yeah, I didn't really know how that worked. All I have done is open accounts and then bought shares for myself. There's one that I'm doing right now that the float's just so low that it's a public bank that is actually going to probably merge with a credit union and become a credit union. And so I tried to figure out where the bottom price was, and I think I bottom ticked it because it's up 30-40% since then.
Great.
And they must just be negotiating price because getting information is tough, but it's a community credit union and then a family bank, and the family doesn't have anybody left that wants to run it. So something's going to happen, and they're just looking for a price from what I can tell. But a little different than what you described. Why don't we finish up with Fannie Mae and Freddie Mac? Because I've been watching them since around the financial crisis, and I still don't have my head wrapped around the thesis or why the preferreds make sense. Where the government is on all of that. Is it ever going to manifest in the value? Can you talk about kind of both the thesis and the mechanics?
Sure. So I own a number of the Fannie and Freddie prefs. It is largely a kind of leveraged bet on this election. I think that if the Democrats win, it'll be a massive delay. It'll be very bad for all of these. Between now and November, it's just a bet on the election. It's that simple.
Okay.
If the Democrats win, it's a catastrophe. If the Republicans win, it's a triumph. And at a much, much, much higher price, one can re-underwrite Fannie and Freddie prefs at the end of the year, either happily or sadly.
Okay.
Trump has indicated that he would kind of reprivatize. Actually, while we were talking, I just got a note from one of the kind of key regulators under his previous administration, just about the timing and likelihood and the meaning of the personnel decisions that he will have to make in a transition team, and kind of how I can best interpret that pick. It'll take a while to get them confirmed in an office, but it's reasonably likely that there's a lot of complexity to the common and dilution on the way out of the current status of the government, but the prefs will likely be made whole. And so just very approximately, these cost a few bucks not that long ago, and they're worth 25-ish in a full kind of return to the private market. And for the sake of liquidity, I own a whole bunch of them just because at different times they were slightly different prices, but they're all correlated. They're all going to be triumphs or disasters, and there are going to be triumphs and disasters between now and the election based on the election. And I had a view on the election that seemed actionable, and they seemed very cheap to me compared to any of the kind of betting markets. I actually had some betting market wagers on as well, but those weren't very scalable, and they've been extremely lucrative so far, but they but the prefs were better. I had besides the just flat out bet on the election and the Freddie and Fannie prefs, I mentioned earlier, I had the Target Hospitality TH, but those are the ones I think are going to be the most positively or negatively affected by the election.
Okay. So that's really an election bet. So,
Yep.
So just so people understand it, right now, Fannie and Freddie are still basically in receivership. Is that the right word?
Conservatorship, but essentially, yeah.
Conservatorship. So if the Democrats win, it probably just stays that way.
Yeah, and there could be a fix in a subsequent there could be a fix in a subsequent. I mean, they're making money now, so that kind of accrues. It doesn't accrue to the pref holders, but in terms of the stability of the business and the ability to take it private someday, so it hurts your IRR. But it's not a zero. It's bad if the Democrats win. But it would remain under the Democrats in conservatorship, and this also matters too. Who they pick, whether they focus on it, but assuming it's not a big focus of theirs, it would just stay in conservatorship during the 4 or 8 years of a Harris administration and a Trump administration. I think 6 months or a year from inauguration, it would be reprivatized.
Oh, okay. Well, I don't have skin in the game on that one. It has confused me. I know it's been sitting out there for years, and
there were a few ways to win. None of them worked so far, right? Like, so there was a first Trump administration. He didn't have his own people in the key positions for much of the administration. There was a litigation solution that failed. So there's been several shots on goal, but none of them have made it so far.
Right.
So you haven't missed anything yet.
Yeah, I'm going to ask you one more question because
Sure,
we talk about litigation. I know that I don't look at it often, and I'm not going to ask you about the company that I'm in that apparently you have a relationship with, but in general, I have watched some of the big hedge funds basically bet on litigation outcomes. And so that got me thinking I should be paying attention to that because those are essentially a lot of time, almost every time, a binary event, right? So when you take a look at a company that is involved in a big litigation or bonds that are out there trading at a super discount, and I think that's the better example. You have a bond out there at a super discount, and some hedge fund or somebody is out there trying to get it to be paid off because of, Argentina defaulting, whatever the case. Where are you finding opportunities in litigation? How do you find them? Are they usually investable from a retail standpoint? How does that all kind of play out for people?
There's a lot of time and a lot of expense, and I don't quite know how I would do a retail version of what I do. I mean, it costs millions of dollars, takes many years, lots of lawyers, and we tend to have concentrated positions. So it's more like buying a house than buying a stock in terms of litigation financing. It's frequently the case that once you're involved, you kind of put in more capital along the way. They need different things. So it would be hard. We have a number of litigations out there against sovereigns. We have a number of, it happens to be fairly concentrated in South America right now, and kind of complicated, time-consuming, potentially very lucrative. And also, it is often binary, but there's also often prospects for settlements as well. I mean, we had one settled today, and that kind of often allows you to kind of split the difference between doom and glory. But we have one that I'm actually wrote about, posting something on tomorrow, called Willis Lease, that's ticker WLFC, that I think is very interesting. And they are dealing, have to deal with assets that were seized in Russia, kind of settling with the insurers on something that could be, it's not a huge part of the thesis. It's a $500,000 market cap, and it'll be another, $20 million or so, but we expect that shortly. So Willis Lease has kind of an aspect of, the kind of settlement or litigation there, and then frequently against sovereigns. And it's a good area. It's kind of rigorous analysis, takes a lot of research and a lot of time. And like poker, you can only think about it probabilistically. and need to not be overly fixated on the specific result in any one time. You just need to get your money on the table with the best expected value, and the winners pay for the losers, and then have something left over at the end.
Okay. So here's where we'll really finish. You have a service on Seeking Alpha, and it's a little bit pricey compared to some of the other services. Tell people what they get for that membership and how it could help them.
Sure. We do a lot of research. We finished sizing our positions at Rangeley Capital. 99% of what I'm thinking about is my portfolio at Rangeley Capital. But when I'm done, it's nice to not be my only audience. It's nice to share my thoughts on positions. So sometimes it's considered derisive when somebody says they're talking their book. I don't know what else I should talk about. I write about and think about the things that I've invested in and share those after we've sized positions. And it tends to have a value aspect, tends to have an event aspect, tends to be highly, highly falsifiable, which would make me a terrible sell side analyst. The sell side, they're always kind of saying things. You put the phone down, you finish reading, like, that sounds vaguely smart. What did he say? And it's never quite, it's always modulated to never be completely wrong. Well, when I'm wrong, I'm completely wrong. I mean, I put out something that's, here's the upside, here's the downside, here's the probabilities, it can work or not. I think it has kind of tautologically, if I've invested in it, I think it has a positive expected value. But besides kind of getting information on those things, you also are free to pick apart my work and take or leave any part. You can not care about it. You can buy it because I bought it for the reasons that I bought it for. You can think I'm an idiot and short the thing that I bought, or buy the thing that I'm short. It really can, be used for whatever your purposes are. We've been there for a while. We have a good community, kind of update ideas as they unfold. And I love it. I enjoy writing. I enjoy the feedback. As a generalist, it's been really useful to me because putting my ideas out there, I mean, you get you get a range and quality of responses, but you also suss out specialists. So if I've kind of, working on every geography, frequently get a note back like, well, I'm the CEO of the mine that's next door to the one you just talked about in Guatemala, going there next week. And I'm like, oh, that's great. That's a lot more access than I've had, or a lot more local knowledge. I love local knowledge. And so I kind of cultivate relationships by putting my best ideas out there, which sometimes just by being a generalist, I've gotten through kind of 60 or 70% of the way through a story, maybe ahead of the market in terms of understanding aspects of it. But there was huge aspects that I'm just not a specialist in. Write about a medical device subsidiary in some conglomerate, and the guy writes back, it's like, well, I'm doing research in that area. And so it's nice when I spent hours on something, having somebody contact me who spent decades on it. And that's been probably one of the best parts of it for me. But yeah, it's called Sifting the World, from a quote from Charlie Munger. And I write, I do content. These websites just do distribution. And they have their strengths and weaknesses there. So I have something that I do on Seeking Alpha. I have something I do on Substack. I have something I do on Medium. And it's kind of a range of topics, a range of audiences. Some are just stuff that's on my mind. Some of it's not even investing. And then some of it's kind of more specific aspects of the kind of investing that I do.
All right. Yeah, that's what I wanted to hear. I have taken away a lot from your service, and for the accredited investor, for the person with the 7-figure account, I don't know how you beat the thought exercise of your service. I really don't. It's really it's impressed me, and I'm a Midwest guy. I'm not easy to impress. So, all right. Thank you very much, Chris DeMuth.
Thank you.
Sifting the World, and we should have this up on Seeking Alpha on YouTube pretty shortly. So thank you everybody for listening in, and have a great rest of your summer.
Thanks, Kirk. We'll be in touch. Talk to you later.
Yep.